This is Optimal Finance Daily, episode 412, How to Invest When You Don't Have a 401k, Part 2, by Kristin Wong of thewildwong.com. And I am Dan, your host here on the show. I'm here each Monday through Friday, reading to you from some of the best personal finance blogs on the planet. And today's episode is a continuation from yesterday's. I read the first half in episode 11, so if you're new here, you will probably want to check that out first before you move on to Part 2 today. And don't forget, we give away books to random people on our mailing list, and that happens on the first of every month, which is in just 5 days. So if you're not on our weekly newsletter yet, now is definitely the time to join. All you have to do is come by oldpodcast.com and enter your email address. Now let's hear part 2 of Kristin's post and continue optimizing your life. How to Invest When You Don't Have a 401k, Part 2. By Kristin Wong of thewildwong.com. I first heard about this option in the Money Book for Freelancers, Part-Timers, and the Self-Employed by Joseph Dagnes and Denise Kiernan. Highly recommended reading for my fellow freelancers out there. A SEP IRA, or Simplified Employee Pension Plan, is basically a traditional IRA for self-employed people. It's designed to allow employers to set up and save money in a retirement account for employees. But if you have your own business without any full-time employees and simply want to save more for yourself, you could open a SEP IRA and act as both the employee and employer. You, the employer, contribute money to the IRA for your employee, also you. It's a great option for freelancers who earn a lot of money. No, that's not an oxymoron. Or just want to save more than $5,500 a year for retirement. You can save up to $53,000 or 25% of your compensation as an employee, whichever amount is less. Solo 401k. The Solo 401k is another option Dagnes and Kiernan suggest for freelancers in their book. It's a bit more complicated than a SEP IRA, but it has potentially better benefits if you want to save a lot of money. We'll get to that in a bit. A Solo 401k, sometimes called a self-employed 401k, works just like any other 401k plan, except that you can open one for yourself as a business. It's designed for employers who don't have any full-time employees other than themselves, the owner of the business. Like any other 401k or traditional IRA, you can deduct the amount you save in your solo 401k. So what's the main draw of this account over a SEP IRA for self-employed people? The contribution limits. If you want to save even more than 25% of your earnings, the solo 401k is for you. In a post I wrote on how to handle taxes as a freelancer, Sam of the Financial Samurai made the case for this type of account. Quote, I go the 401k route as a freelancer because it allows you to potentially contribute up to $54,000 in pre-tax savings. SEP IRA is only 25% of operating profits, which I guess you can get to $54,000 as well if you make $216,000 in operating profit. But with a solo 401k, you can contribute $18,000 on much lower income, like $50,000. Whereas if you made $50,000 in operating profit, you can only contribute $50K times 25% for the SEP IRA, which equals $12,500. End quote. In short, the solo 401k gives you more flexibility over how much you can save. In reality, though, most self-employed people will probably do just fine with a SEP. If you want to save more than 25% of your income for retirement, though, it's something to look into. If the idea of opening a retirement account on your own seems too daunting, you can always go with a robo-advisor or a certified financial planner. Robo-advisors are digital solutions to investing. It's usually an app that opens an investment account on your behalf and then walks you through how to save in that account, doing all the legwork for you. Keep in mind, though, not all of these apps open retirement accounts for you. Some of them are just regular old taxable investment accounts. That's not necessarily a bad thing, but if you're trying to save for retirement, the main reason most people start investing, you'll want to double-check that whatever service you use is indeed opening a retirement account on your behalf. Also, some of these accounts, like most 401ks, come with higher fees than you'd pay investing on your own. If you are interested in investing with a robo-advisor, you can find some recommended reading linked in this post. If you're new to freelancing, I would highly recommend talking to a certified financial planner who can also help you navigate how to save for retirement and how to invest. Just make sure your CFP is an actual CFP with the little logo behind their name. That logo is important. It means they take an oath to work in your best interest instead of just selling you investments. Look up legit CFPs at cfp.net. Finally, Once you know what kind of account to open, the next step is figuring out how to actually start investing in that account. I don't want to leave you hanging, so there's a complete guide I wrote along with my former Lifehacker editor about how to invest at lifehacker.com, and that also is linked in this post. You just listened to part 2 of the post titled How to Invest When You Don't Have a 401k by Kristin Wong of thewildwong.com. And before we go, this will probably be my last reminder to you about our book raffle happening at the end of this month. If you want to be a part of that, plus get some free spreadsheet tools, a video tutorial, and more, all for free, come by oldpodcast.com and join our weekly newsletter. And that's it for today. Have yourselves a great Tuesday if you're listening in real time, and I will see you in tomorrow's show where your optimal life awaits.